Hello, I'm Donald Leggett, and welcome to the latest London South East CEO interview. I'm joined today by Jason Sayers, and he's the CEO of AIM-listed Filta Group, and they are the kitchen services provider who specialise in cleaning and removing kitchen oil at the end of life, and who are increasingly focusing on their environmental credentials. Filta, ticker FLTA, operate a franchise service in the US and Europe, and have both direct and franchise operations in the UK. The current market cap is £43 million, and the group have just announced their interim results. Okay, thanks for joining us today, Jason. It's a real pleasure to see you.
And you, nice to meet you, Donald.
And I understand you live and work in Florida these days, Jason.
Yes, we bought the business out here 19 years ago. Myself and my business partner came over, and we've lived here ever since and built it in the States. So yeah, live and work in Florida. I'm lucky.
So presumably that's helped you expand the business in the States, given, that's home territory for you.
Yeah, well, if you think about it, we deal with cooking oil. That was our core business, and there's a lot of fried food in the States. It's kind of a culture out here. So we thought this is the best market for us and bought the service over here, as I say, 19 years ago now.
So that makes a lot of sense. Let me take you back to the start. Let's actually do this as a formal interview and ask you to describe the Filta business in the UK, Europe, and the States. Or maybe it should be the States, Europe, and the UK. You tell me.
Well, I started the business in the UK, and really, as 2003 came out to the States with the concept of Filta Fry. So Filta Fry is cooking oil filtration and fryer management service. So we would go into a customer's premises with a machine off a van next to the fryers, suck the oil out the fryers. The machine filters the oil. We clean all the fryers, put the oil back in, and the customer reuses it. So it prolongs the life of oil. And at the end of its life, the oil was then taken away for biodiesel. So we took that service in the UK and we brought it to the US. We grew it in the States, became pretty sizable here in the US over the years. And we sort of changed it from a single unit operator model where a guy in the UK buys himself a van and a round. Here, people build bigger businesses. So franchisees here have $3 million in revenue. Just filtering cooking oil and frying management. It's nuts if you thought about it, when I started the business. So we came out to the States, grew it here. We then, sort of going back to the UK, we had a smaller operation there, but we've expanded into a couple of different businesses there, which is fog management, so fat, oil and grease management in the drains. Same customer base as commercial kitchens, but we separate oil and water before it goes down the drains, so it stops the drains getting clogged with fatbergs, etc. We bought a business in the UK doing that, so we were a bit more company owned in the UK. And we're also in Germany, where we used to have a master license holder there for Filta Fry. We bought that back, and we now have that we own it in Germany. We franchise out there through franchisees, and it's growing there nicely too. But the core business is the Filta Fries in the States and the UK. That's kind of the mix we have.
Okay, give me a sense of the different sizes of the States, Europe, and the UK. Give me a breakdown in terms of revenues.
So if you separate it to start with franchisees' revenues, so the customer service avenue we have, our franchisees in the US are close to $70 million in revenue with their customers. We obviously get royalties and other fees from that, and that's our revenue. So our revenue is split fairly evenly between the US and the UK, because in the UK, our customer service is direct, so we get 100% of that revenue. In the US, our revenue is primarily the royalties, etc. So 50-50, even though the business is bigger in the US. And Europe is young for us. Obviously, it's probably about 1% of our revenue now, and we're looking to grow that, but COVID took a hit there as everywhere else, and we were a lot earlier in our life cycle there. So about 50-50, it changes slightly. During COVID, it's been weighted back to the US a bit because we came out of it quicker and continue to, but we expect that to balance again probably next year.
And where do you see the growth coming from? Are you going to split that evenly across your different sectors, or is Europe really, you're going to put the foot to the pedal?
Across the board, we normally look for about 20% growth in each of our markets. So if you took that to our franchisees' revenues, going from 60 to 72 million a year, we look to drive that. So we support our franchisees. We provide them with telesales support. We help them get customers. We help them get new technicians. Everything's led from those franchisees' revenues increasing. In the UK, we look at 20% growth a year, and in Europe, we look at higher percentage growth, but doesn't mean a lot to our overall revenues because it's quite a small piece right now.
It's a low base, from a low base, yeah.
Yeah, correct.
Okay, so we've kind of touched on lots of this, but okay. Talk me through a typical customer transaction. What might you do for them from top to bottom?
Okay, so the filter fryer business, as I mentioned, we take care of their fryers, and people see us as a filtration business. We're not. We manage people's fryers for them as an overall thing. So people outsource the frying operations to us. So if you say some of our larger customers, we have stadiums with over 200 fryers in those stadiums. So this isn't just a restaurant. In the US, restaurants represent less than 50% of our customer base. We have schools, hospitals, universities, sports stadiums, amusement parks. So we have some real sizable customers there. So we would take care of their fryers. After events, we'd be in there, we dump some oil, we clean fryers. There's a whole industry around fryers. We even train staff how to cook properly, how to fry properly as part of fryer management in the US. That makes us very, very sticky with our customers. So we have a lot of contract catering customers, Compass, Sodexo, Aramark, Delaware North. They have a lot of sites and they have training credits for their staff that their managers have to give them each month. We're part of that. They get training credits for taking classes from our franchisees. So we really are sticky with our customers in that respect.
You have a low churn rate?
Very low churn rate. We keep customers for years, and the average customer is about $9,000 a year for us. So once we spend a bit of time getting a customer, we do surveys up front. We do a 2-week monitoring exercise. But once we have those customers, unless we really mess it up, we do keep those customers forever. And you'll see, we just had a release about ESG side of things. We provide them with environmental impact reports, and we have done for 10, 15 years now, which details in real numbers what savings they've had on the environment because we prolong the life of oil or we send their waste oil to go to biodiesel. So it's a very deep service, if that's the best description, our filter fry service with customers. We provide another couple of services in the States, but they're sort of peripheral. Once we're there, we can spray their drains with enzymes that eat the grease, so it stops them getting clogged in the States as a service of just going and spraying them. And we have panels we put in coolers in the US, but it's all to do with that same customer base. Rolling over to the UK, we serve customers directly. Our core ones are, as I mentioned, we separate oil and water before it goes down the drain, so it stops the oils getting clogged stop the drain getting clogged from oil. But we then have other services. So the same customer base, we manage their seals on their fridges for them. So the same customer base, we go in, seals start to wear, we go and replace them as a service. We've got a patent that allows us to turn up, measure, and manufacture the seal on the van there and then. So it's a lot quicker and cheaper than other services. We introduced a service just pre-COVID, so it's taken a little while to get going, which is a vent. So extract vents over the cookers go out to air. And those need cleaning every 3 months by law, maybe every month, every 3 months, depending on the size. We have a system we fit that sprays bacteria, enzymes into every hour or so, which eats the grease in there. So it saves people going up there and scrubbing it. We have an automated system. We've just fitted it with the first chain in the UK, Oakman Inns. Their whole pub chain now has that. So it saves them money, it's environmentally friendly, and keeps the fire risk down significantly, because instead of they're having build up in grease and then it goes away when it's clean, it's constantly clear of grease. So we have these different services we sell, but really the same customer base we sell them into.
Okay. Does this increased focus on your environmental credentials? As you said, you've just launched released that ESG report. does that help you retain business, grow business, and increase margins? Particularly, does it actually lead to increased margins?
It may be perceived as this is new for us. This is what we've always done. We always have been Filta Environmental. I think with the push for ESG now, with customers, as with investors, etc., our ESG credentials are really coming to the top, and we've just kind of launched that now to show people. Most people have seen what we do at the customer level, but really at the investment level, they're now seeing, yes, we have these environmental services. They are repeat revenues. We haven't changed the model at all. We're just putting our head above the parapet and showing people what we do on that. And we also haven't launched yet. So we've done the environmental impact reports for the existing service we have, FiltaFry, and that's cool because that's the big chunk of our revenue. In the UK, for separating oil and water going down the drains, we're about to release that in January, the ongoing environmental reports on that, which really affects biodiversity. Stopping oil going down the drains and getting into the water system is key for that. So we're actually going to, alongside a decent customer in the UK that we manage, we'll launch something on that in the new year to show everything we do on that front.
That's absolutely fascinating, isn't it, Jason?
Yeah.
So you've always been in the right place, and now it's also
the world's catching up with us.
Yes, indeed. So less happy things, less happy thoughts. How tough was COVID, and how's your balance sheet looking as a result?
Tough. So industries that are hit hardest, probably airlines, cruises, restaurants. We're right in the middle of that. That's our customer base is commercial kitchens. And ironically, in the US, there was a big lockdown right at the beginning for 3 months. And our franchisees, the business model is we give them some big customers, national contracts with the stadium. We do over 300 stadiums in the US, 300 universities, big, sizable, chunky business. And it's there. The business model is they go around and fill in with restaurants, etc., around that area to build a good mixed business. Those that just kept to the big stuff and took it easy lost out because it took a long time for the stadiums to come back and the universities. Only just recently are they coming back. Ironically, restaurants came back directly after those 3 months last year because they adapted quickly to deliveries, collections, and all those came back on pretty quickly. So those that had a decent mix of business got back to maybe 70, 80% of revenue quite quickly. Those that relied on the big stuff or were in states that had complete lockdowns struggled a bit more. For us, and the UK was the same. We service 2 big pub chains there, contracts with Mitchell & Butlers and Greene King. Closed down completely for a long time. We focused all our efforts on fast food and on supermarket chains and pieces we thought would survive and go, because nobody knew back then whether people would survive or whatever. So we focused in the UK on different types of places we thought would come out well, and we've done pretty well with that. We've got some new good customers, KFC, for example. We're in with the supermarket chains, the major ones. So we refocused a little bit on that. So we were affected significantly. We're now back to record revenues we've ever had as a group. So the last 2 or 3 months have been record revenues, record profits for us. So we're in a good place right now. In terms of the balance sheet, one of the things we focused on, as I'm sure many businesses did at the beginning of COVID, cash. We needed cash. We wanted to make sure we have enough cash to get through this. You didn't know if it would be 6 months, a year, 5 years. No one kind of knew. Our team did a really good job on cash collection. We came out of COVID with more cash than we went in with. We took advantage of different programs in different countries for that. But we've got 0 net debt now as a business. So we've paid off everything. We're doing pretty well on that front. So really, really pleased and proud of the team, what they've done through that COVID period. But it was tough. It was very tough.
Now, I've watched different interviews you've done with various people, and finding good quality technicians. You've mentioned that as being a big drag on growth. Has Brexit made life harder? Brexit, and the dreaded Brexit, and what can you do to sort those issues out?
So I don't believe Brexit has affected us directly. So in terms of importing, exporting goods across border, we're not affected by that because we're a services business. We manufacture all our machines in the UK.
Brexit in the UK has meant that lots of people have gone home. EU nationals have gone home, and lots of different sectors. There's nobody to pick the vegetables in the fields, for example. There are all sorts of Brexit implications. It's not just import-export. Right,
I was about to come on to that. So in terms of people, we only had 3 people on our books in the UK who were from overseas during that. They went home from Poland and somewhere else. Went home beginning of COVID. Ironically, 2 of them have come back, but we haven't directly been affected. But the labour pool across the UK has been affected, which makes it harder for us to recruit. And who knew, again, during the beginning of COVID or right at the end of last year, that we would come out of this with a massive labour shortage. We thought there'd be high unemployment.
It's counter-cyclical.
Absolutely. So, obviously we could see it come in the last few months, but before that, it's been tough. So if you take the different markets, the US, absolutely tough getting employees. We're growing quickly, I would say, at the moment, very quickly. We could grow quicker with staff. So we've hired, we only have, now it's about 18 staff at our head office in Orlando. That's it. The rest is franchise. 2 of those staff are full-time recruiters, helping our franchisees recruit technicians. So you're out in the field as a franchisee, you're busy. The one thing you don't do is get an inquiry for a job. You're busy, you might reply later. That guy's got a job already. So we're on the phones, we help them at that front end. We reply to every inquiry via text, speak to them, and then we present our franchisees with qualified candidates. We try and do that grunt at the front work at the front end to help them. They employ them at the end of the day in their markets, but we can help with that. So we've put some resource into helping with that. And it's tricky, particularly in different markets in the States. It's like 50 different countries, and different markets have been trickier. I think it's getting slightly easier right now. The word is in different markets. The US had the added thing where they boosted the unemployment benefit significantly here, which stopped in September. And everyone thought that would be the panacea coming back, that would solve everything. It hasn't, but in certain markets it's helped. But it's tough. People don't want to do these jobs anymore. We were chatting earlier, Donald, people enjoy working at home. It's been, people have got used to it, whether it's I'm now going to go into the office 3 days a week in the city, or whether that people are looking forward to a new, different life. There's change. And that's throughout the whole of society here and everywhere. People have changed, and we're adapting. We are employing people here. We're doing it, but it's an effort. In the UK, similar. We're recruiting people right now. It's a tougher market. Ironically, we had people leave post sort of opening, April, May, US and UK. People thought they've gone through COVID, they've been paid, they think, I want a bit of a change. It's been building up. There was change for about 2 months. People have come back who left, who wanted a bit of a change. Because the grass isn't always greener. But that churn stopped for us then. We haven't had much churn since then. Now it's about recruiting people for growth. And that's proving harder than it was before, but not impossible.
One of the changes that we've all noted is that people have taken to investing in the stock market, Jason. So, which takes me neatly to who holds your stock and what does the free float look like for Filta? And the big question, why should retail investors buy your shares when there are lots and lots of new and interesting IPOs coming to the market right now?
I think to answer the first question, our directors, we own 65%, I think, roughly. We have another significant shareholder, and then there's about 20% free float. So not the biggest free float of any business, but we have held on to the majority of shares for our own purposes. We know where this business is going. So we're excited by that. But you're right, the free float is a bit smaller. In terms of investing in us, we aim for 20% growth a year. We're comfortably getting that now, but who knows, COVID hits again or something, but we get it. That's our growth. When you look at a business like ours, a high, 40% plus gross margin, that drops to the bottom line pretty quickly. So, we were growing nicely. We had a tough time with an acquisition in the UK we had for a year. We got over that. COVID then hit our industry. We're now seeing the growth that this business can have. We're seeing that now. And, we have fairly fixed overheads. So once you start delivering that top line growth, a lot of it does drop to the bottom line.
Any thoughts on a dividend coming back, Jason?
Yes, yeah, absolutely. So we've been very conservative. As I said earlier, conserving cash was key for us. We didn't pay the interim dividends a couple of months ago. We just want to see where everything went, just to make sure. We're confident that at the end of this year, we'll be back to full dividends going forward.
Jason Sayer, thank you so much for joining me today. That was very interesting. Thank you so much. Filta have a bulletin board on London South East, so please do jump on there and share your thoughts about this interview. And if you'd like to comment about Filta, our Twitter account is @London South East. And to get alerts to interviews like this one, just Google London South East YouTube channel and do subscribe. Thanks for watching, and as ever, do stay safe.